angle's right and so forth, an expert would have no problem with it. But for me, this is a pretty hard shot. Oh, close. Most of the time, we're not expert billiards players. When people face hard problems, they make mistakes.
At the center of all the rational models lies an unflinching belief in free markets. The idea is to keep regulation and government interference to a minimum in both the everyday consumer market and in the giant money markets of Wall Street. Rational economists believe that the increase in wealth worldwide over the last 30 years is a triumph for free markets.
It lifted maybe 1 billion people out of real poverty, and I mean real poverty. They had $1 a day or $2 a day. That's real poverty. And it lifted those people above those limits.
What in the world is happening on Wall Street?
Then comes the crash of 2008.
Veteran traders say they've never seen anything
The stock market drops over 40%.
The Dow traders are standing there watching in amazement, and I don't blame them.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow...
And apparently, irrational financial behavior becomes the order of the day.
Let's talk about the speed with which we are watching this market deteriorate.
$14 trillion of wealth invested by Americans is destroyed.
This has truly been a manic Monday on Wall Street.
Fear grips the markets.
The stock market suffered one of its worst days in years.
And financial experts are forced to imagine the once impossible.
We haven't seen anything like this since the Great Depression.
The global economy coming to a halt.
I shudder to think of it. If all of that stopped, the consequences are beyond imagination. There would be hunger, there would be war, there would be strife, there would be total unemployment.
We were having an electronic run on the banks.
It would put the world back 100 years, maybe more.
The chaos seems to undermine decades of economic thinking.
Economists as a whole didn't see it coming. So that's a black mark on economics, and it's not a very good mark for markets.
This market took 5 years to go higher. It's now down 40%. This was
With the crash, the rift in economics widens between the rationalists and the behavioralists.
We are talking about financial Armageddon.
The crash really matters because much of the behavior that led up to the crash is unexplained by the discipline of economics.
I'm sorry, it's just an empty argument. That's just an insult, a pointless insult.
Well, I don't see this as a failure of economics, but we need a whipping boy. And economists have always kind of been whipping boys, so they're used to it. It's fine.
Had an 8-day losing streak in the Dow.
So which side is right? Are we rational about money? Or do our emotions and psychology play a much bigger role than previously realized?
Okay, everyone, we're going to start off with a game.
Take the auction of the $20 bill that sold for $28.
$1. $1. How about $2? $2.
In the rational model, a person should never pay $28 for a $20 bill.
5 in the back. How about 6? 6.
Paying more than something is worth cannot be in anyone's best financial interest.
9.
The auction is a key experiment for behavioral economists.
12.
It's designed to be a trap. And it's a trap that if you don't think more than a couple steps ahead, you fall into.
11.
12.
It's the emotional desire to win that drives bids up.
14. 15. Do I hear 20?
And the fear of being the loser that drives them even higher.
23. 24. 25.
And now it's a game of chicken.
27.
27 go once.
28.
28. $20 sold for $28 to this gentleman. And you owe me $27 as well. So
Nobody will want to play that game twice.
The auction may seem far removed from everyday life, but do people outside of the classroom behave just as irrationally? We asked shoppers in a Chicago mall if they would prefer $100 in a year's time or $102 in a year and a day.
I'll take the $102 in a year and 1 day.
$102.
Year plus a day.
And then I can wait that extra day for the $102.
Yeah, for extra $2.
Yeah,
it really won't make me a difference.
I would do the 102 a year and a day from today.
They all made the rational decision.
What's one day after a whole year of waiting?
And chose the larger amount. Then they were asked if they would prefer $100 today or $102 tomorrow. The larger amount is still the rational choice. So what did they say?
Oh, I'll take the $100 right now.
I would take $100 today.
I would prefer the $100 today.
Today.
I'm taking $100 today.
The desire for a quick reward.
$100 today.
Trumps their rational self-interest.
There's something called present bias. That if we have the option of something right now, it's very tempting to go for it.
According to behavioral economists, this bias may explain why we save less than we should. And there are other psychological forces that impact our decisions.
Bottle of wine about in the survey is...
In this experiment, students are asked to bid for a bottle of wine. Rational economics suggests they will carefully calculate what it's worth to them. But before the bidding begins, they're asked to write the last 2 digits of their Social Security number on their bid sheet. Astonishingly, the people who bid the highest for the wine were those who had the highest Social Security numbers. Unwittingly, they've been influenced by a completely irrelevant number.
It is a great illustration of anchoring. People are anchored on some number they were given, even when they constructed it at random, like the last 2 digits of their Social Security number. It's an almost irresistible force.
Do experiments like these expose flaws in the assumptions underlying rational economics?
They're dealing with people in the lab. Economists are dealing with people in the real world. And there's a difference between the lab and the real world.
These experiments are very interesting, and I find them interesting too. The next question is, to what extent does what we find in the lab translate into understanding how people behave in the real world? And then make that transition to, does this explain market-wide phenomena?
For economists like Cochrane, it doesn't matter if individuals sometimes go against their financial self-interest, as long as most of us act rationally about money most of the time. Nowhere is that idea more important than here, the New York Stock Exchange, where traders buy and sell corporate stocks. Their decisions move prices up and down, creating wealth for some investors and financial loss for others. Richard Rosenblatt's been trading here for 30 years.
All right, hang in there. I'll see you later.
Thanks, Rich. Take care.
When I started, our technology was electric lights and telephones, and that was pretty much it. And yet, it's still the same job. Try to anticipate where the stock is going to move over the next few seconds or minutes and judge your trading decisions accordingly. And if I'm right, and I buy a stock in anticipation of other people deciding that this stock is underpriced, then I will realize a profit.
Now, the stock exchange is one small cog in a vast global machine that's the financial markets. Technology means trading can take place anywhere.
Trading up $2 on earnings. We got 50 to buy.
At night trading, one of the biggest private dealing floors in the world, traders buy and sell everything, from stocks and currencies to commodities like